Hi, good morning to all. In this video, I am going to discuss about what is meant by candlestick pattern. What are the types of the candlestick patterns available in share market. In financial technical analysis, a candlestick pattern is a movement in prices shown graphically on a candlestick chart that some believe can predict a particular market movement. The recognition of the pattern is subjective, and programs that are used for charting have to rely on predefined rules to match the pattern. Candlestick charts are widely used by traders and investors. Candlestick charts are used from late 20th century and into the 21st century. These candlestick formations are popular, useful in current financial markets. The history of candlestick chart goes back many centuries. Many successful traders use candlestick chart today because to getting accurate trading signals. This can improve your trading strategy and also improve your profits. Formation of candlestick patterns. The candlestick chart is similar to the bar chart or open, high, low, close. It is defined as shortly in OHLC chart, with the main difference being that the area between the open and close is represented by the wide area. This is the wide area, described as the body of the candlestick. The upper and lower lines, this is the upper line, this is the lower line. The upper and lower lines above and below the body are called the shadows. Upper shadow called as the wick and the lower shadow is called as the tail. This is the tail. If the difference between the open and close is positive, so if the market moves up in the time frame of the bar, then the wider area is traditionally unfilled or hollowed and today is often colored as green. If the difference between the open and close is negative, if the market moves down in the time frame, the body is conventionally filled in or is a darkened area and today is often colored as red. This is the fine example of how to formation of candlestick patterns. H means high, C means close, O means open, L means low. The lower shadow is called as tail, the upper shadow is called as wick. This is another example of candlestick formation. Standard line. What is meant by standard line? The standard line has a strong body. This is a strong body. A relatively long body compared to a normal candlestick. And a relatively small shadows. This is the small shadows. The standard line quite simply indicates a continuation of the current underlying trend in the direction of the standard line. For example, this is the example of standard line. What is meant by Maruboso candlestick? The Maruboso candlestick is similar to the standard line but has a much longer, therefore stronger body, and has no upper or lower shadows. There is no shadows. You can see there is no shadows. Like the standard line, the Barbosa candlestick also indicates trend continuation, but a far more forceful continuation signal. If the market retraces, if the market retraces in the next bar in the opposite direction to the Barbosa candlestick, the 50 percentage level, this is the 50 percentage level of the This is the 50 percentage level of the Barbosa candlestick range is seen as initial support or resistance. What I am going to tell you that it may reverses from 50 percentage of the Barbosa candlesticks. Suppose this is the Barbosa candlestick. The next candle is open in that place. If the candle is falling 50 percentage of the previous Barbosa candlestick, it may reverse us in this place 50 percentage of this level. This is the strong support area. This is the bullish Barbosa candle. This is the bearish. This is a Barbosa open. This is a bearish Barbosa open. The bullish Barbosa candle. This is the Barbosa close. This is the Barbosa close. Next candle type is spinning top patterns. Candlestick spinning top patterns have a very small body and relatively long shadows are weak at the top and bottom. This is the top in the bottom. This is the weak in the bottom. These spinning top patterns are considered neutral candlestick patterns that might signal consolidation, indecisions, or a lack of immediate directional conviction. We are now going to look at 4 candlestick charts signal a bullish shift in direction from bearish. This is the bullish spinning top. This is the bearish spinning top examples. Now we are going to look at 4 candlestick charts signals a bullish shift in direction from bearish. First one is hammer candlestick. The hammer candlestick pattern is formed in a prior downtrend. When forming the hammer candlestick, the market dips and rebounds to close significantly above the low, closing near to or at the high of the candlestick. The confirmation of hammer candlestick is signaled by a close above the hammer candlestick high in the next 1 or 2 candlestick to indicate a reversal of the prior downtrend. This is a good example of hammer patterns. In this place, the strong support or prevails in that place. Next, we are going to see about dragonfly doji candlestick patterns. The dragonfly doji is very similar to the hammer candlestick pattern, but the difference between the open and close is very small or at the same price. There is either a very small or no body. As with the hammer candlestick, a close above the dragonfly doji high is required in the next 1 or 2 candles in order to confirm a reversal of the prior downtrend. This is the place market rejects this level as bulls take control. The bull signal through here. Next, we are going to see about the inverted hammer candlestick meaning. Next, we are going to see about inverted hammer candlestick pattern. The inverted hammer which is an upside down version of the hammer. The inverted hammer, which is an upside down version of the hammer that occurs in a prior downtrend. During the formation of the inverted hammer candlestick, the market pushes lower, then rebounds, and then fails back lower again to close significantly below the high, near to or at the low, but the market still has quite some work to do signal a bullish shift, needing to close above the inverted hammer candlestick high in the next one or two candlestick to signal bullish shift in trend. The inverted hammer, which is an upside down version of the hammer that occurs in a prior downtrend. During the formation of inverted hammer candlestick, the market pushes lower, then rebounds, and then fails back lower again. Because in this place we have strong support. The market pushes lower, then rebounds and fails back lower again to close significantly below the high, near to or at the low, but the market still has quite some work to do signal a bullish shift, needing to close above the inverted hammer candlestick high in the next one or two candlestick to signal bullish shift in trend.